Look, in January of 2026, silver went up about 70% in a month. I mean, how many times have you and I done, interviews together and, silver moved, 10% for the year or 20% for the year. And now we're seeing 70%. So it was overdone for a while. It's recaptured its bullish trend. And I think we're going to go up again. But I also think we have consolidation to work off the large increase that we've seen. And I'm pretty convinced we're going to see a sideways action in a trading range for both gold and silver for probably 6 weeks or thereabouts. Could go longer than that.
Silver has been moving quickly, and last week showed just how sensitive the market is right now. Prices went up midweek, then dropped a bit and started just moving side to side. The silver price prediction landscape has shifted dramatically since January's record. The Reuters poll of analysts now projects a 2026 average of $79.50 per ounce, up from $50 as recently as October 2025. Yet the most interesting signal is not coming from the price chart at all. It is coming from the physical market, where Comex registered inventory has fallen to levels that exchange analysts flag as stress territory. Veteran financial expert DavidMorgan explains that silver doesn't always react to war in the way investors expect. He notes that in the early stages of conflict, capital often flows into the US dollar and government bonds for liquidity, which can temporarily push silver prices lower instead of higher. He points out that both gold and silver had already rallied strongly beforehand, making a pullback and consolidation phase as necessary. This outlook aligns with recent market developments, where despite geopolitical tensions and volatility, precious metals have shown mixed short-term reactions, while central bank demand, particularly from countries like China, continues to provide strong underlying support. Moving forward, Morgan explains that this pause is actually constructive, as it forces out short-term and over-leveraged participants, leaving behind stronger, long-term holders. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from DavidMorgan's recent interview.
You look at the chart of silver's price and other war situations, you'll find actually the trend is counterintuitive. You get in the war cycle and you actually see the silver price go down for a while, and then you can see it bounce back. The reason is not an absolute, but the best determination I think is valid is the whole system still runs on interest rates. It runs on the treasury bond market of the United States. That's the primary source of what everyone trusts. I'm not just talking citizenry, I'm talking primarily the broker-dealer relationship in the central bank system relies on the US dollar. So when things get wacky in a war situation, rather than go to gold, which would be expected, they go back into the US dollar. And that's in the form of treasury bills, treasury bonds, treasury notes, dollar itself, currencies moving out of foreign currencies into the dollar, and that type of thing. And I'm pretty sure, in fact, the data shows that that is what has occurred. And so that took gold down. Plus, honestly, to be objective as I can, gold, especially silver, got a little bit ahead of itself. I mean, look, in January of 2026, silver went up about 70% in a month. I mean, how many times have you and I done, interviews together and, silver moved, 10% for the year or 20% for the year. And now we're seeing 70%. So it was overdone for a while. It's recaptured its bullish trend, and I think we're going to go up again. But I also think we have consolidation to work off the large increase that we've seen. And I'm pretty convinced we're going to see a sideways action in a trading range for both gold and silver for probably 6 weeks or thereabouts. Could go longer than that. Gold hit the 200-day moving average and bounced off it pretty strongly. And gold is still going to lead this market, although silver did catch up quite a bit last year where, gold was at the $3,500 level and silver hadn't done anything. And then after the summer, it started to really catch up to gold. We saw the gold-silver ratio go from, I forget the exact numbers, but from something like 100 down to 60. And we're in the mid-60s right now. I said weeks ago that I saw a trading range between 70 and 90, which is a big spread. It looks like it's going to be more like 70 to 80. These are round numbers, but I also use OCO, on close only. I'm not trying to get too deep in the weeds here, but the way I've traded them, used to trade a lot more frequently than I do now. But at that time, I was taught the intraday moves are important, but it's on the close, OCO, on close only, that you really want the data. And I've integrated that. So if you go to OCO, you'll find that 70 number is pretty valid. You'll see those 60 prints during the day on the close. Most of them are above 70, not all of them. But when you're doing a channel formation, it's not a perfect up and down in a perfect range. It's, again, an art form more than a strict, principled math formula. But nonetheless, you get a pretty good feel for it. So I think we're doing exactly what I would expect at this time in the market. And unfortunately, in my opinion, the people that were late to the party or maybe bought it at 50 and watched it go to 100 and didn't get out, or people that are on leverage, or people that expect silver to, make up for all the mistakes they made in other investment arenas and what have you, are expecting too much. So the market going sideways will wear them out. And they'll say, you know what? I bought silver, cost me this much. The spread is this much. I'm kind of just breaking even. I've held it for, 4 months. I'm tired of it. I don't like it. I'm going to get out. And those people, the weak hands, as we call them, leave the market. And once that happens, I shouldn't laugh, but I've been there, done that. We will see the market take off. Yeah, thanks for backing me up on that. I mean, it's not something you can do all the time, but when the advantage is there, it's 100 to 1. And just think about the people who did that were maybe all silver or too much silver, however you want to frame it. And it went from 100 to 1 to 50 to 1. All of a sudden, they doubled their gold position. Of course, there's, fees and all that. So it's not exactly double, but in theory, it's double. And, gold's a lot easier to, stack. And, it's a lot smaller volume. And I always have taught that you should have both. They really serve different purposes. And silver, as we all know, is just much more volatile. But to make that trade when, you're kind of tempted to buy gold and it's getting all the news headlines and the institutions are buying gold and central banks are buying gold and gold. But you look at that ratio, man, I'm going to buy silver because I want cheap gold. And you buy it 100 to 1, then it gets to 50 pretty quickly when it moved. And you swap that, you feel pretty happy. You bought gold basically at half price.
In the discussion, DavidMorgan highlights that large delivery figures in the Comex can be misleading. He explains that much of the activity is simply internal transfers between major institutions like JP Chase and HSBC, where ownership changes but the physical silver remains in the same vaults. This is why overall inventory levels have stayed relatively stable, despite heavy trading volumes. However, he emphasizes silver has increasingly been flowing out of Western storage and into physical demand centers in Asia, through platforms like the Shanghai Gold Exchange and strong buying from regions such as India. With global demand outpacing both mining supply and recycling, tighter conditions could eventually lead to delivery delays or shortages. Ultimately, Morgan underscores by stating that although the silver market moves in cycles, the broader trend points toward increasing strain on supply. Silver's 2026 gains are driven by tight supply, ongoing deficits, and strong industrial demand. Inventories on the Comex remain constrained, while the Silver Institute projects a sixth straight annual deficit. At the same time, rising demand from tech and energy sectors, along with record imports by China, continues to support prices. Let's jump into the interview.
What's very interesting is, the amount of deliveries. And this is talked about almost ad nauseum, and especially in the last couple of years. I mean, people such as myself and Ed Steer and Ted Butler, some of, let's say, the early silver people, I've looked at this, on the delivery month over and over and over again. And even though there's massive amounts of deliveries, especially in the last year, the amount of inventory varies very little. Going past the last 4 years, we basically have a in and out, in and out, in and out, but basically pretty darn flat as the amount of physical silver. And the reason for that is that a lot of the deliveries are bank to bank. So the silver actually sits in the warehouse, but the new owner is holding that in the same warehouse. So for example, you could see a pallet full of commercial bars and it says JPM for JP Morgan. And then after the delivery month, JP Morgan is delivered to HSBC. So the tag that says JPM gets pulled off that pallet and the sticker that says HSBC gets thrown on there. And that's almost literally what happens. Now, not in every case, of course. But what we're primarily interested in is how much silver comes off or out of the Comex warehouse. And so what we could see in 2025 is we had this huge influx of silver coming in to the Comex warehouses. We call them vaults, that's what they are. And we saw that rapid increase. Now, some say it was tariffs, some say it wasn't. I'll just say facts are facts. We got an increase in inventory, regardless of the reason why. And then it flattened out, and that same amount of inventory basically left the Comex warehouse for kind of an in, leveling, and an out, and basically back to the starting point where we started in 2025. So we're slightly below that. But what is important, and I think Andy Schechtman has made a point out of this, that in the last few months, we've seen a rapid outflow from the Comex warehouses to wherever it's flowing. I would suggest some to the LBMA, and I'd say most of it from, I think, everything that we that follow the silver market can determine on a best effort basis over into Asia, into the Shanghai Gold Exchange, Shanghai Metals Exchange, the Asian market, and India too as well. So those two markets. So the idea that you can just look at what the open interest is and how many people are standing for delivery, you got to take it with a bit of a grain of salt, because even though those deliveries are valid, many of those inventories and exchanges really don't move the overall supply in the company. If you go back and look at, some of my earlier work, I have made the proposition that there would be some point where there's a very strong demand that might not be met or delayed or that type of thing. And we have already seen that occur a few times. I mean, Andy Schechtman of Miles Franklin has talked about a point in the retail market where he could basically not find any silver for retail products, and that I turned him on to an outfit that was in the industrial side called Pyromet. And Pyromet was making 100-ounce bars that were not the best looking bars ever, but that was, I think, if I recall correctly, about all he could source for a while as far as silver product. Now, that subsided over time, but we've also seen on the commercial bar side. I remember, I think it was the second tranche that Sprott Asset Management bought for the PSLV. And if I recall correctly, it was 22 million ounces, I believe correctly. And the silver was delayed, not by a lot, by a few weeks. But nonetheless, the demand delivery date was not met. A lot of it was, but there was still, I forget how much, 5% or so that had not met the delivery date. They came in, and so I got pretty excited. They're very short on commercial bars, which is really the silver market. I mean, retail is very important, but it's a derivatives market based on commercial bars. So that's what I focus on. I focus on everything, but that's the one to really see what would occur as far as a quick movement or a quick adjustment in price. Because if you couldn't deliver a 1,000-ounce bar, that would really throw a wrench into the gears, so to speak. So I thought, that's it. Well, a year or two goes by and they have another tranche, which was, I think, greater than that one. And, they delivered it early. So, I mean, the silver market does ebb and flow. And there is always, more mining, more recycling. And sometimes the market is very tight and sometimes the market isn't so tight. So not trying to be too long-winded, Elijah, the overall trend is very clear. We're using up more than we're mining. We're using up more than we can recycle. So somewhere down the road, that's going to occur to a point where it's going to be very tough to meet the demand without a big increase in price and someone willing to sell silver, for fiat. And that's what we've already seen. We saw that in January. And I think that we're going to see it again. And I think the next time that we see it, we could, and not would, but could get in a situation where We get information, which you've already seen before out of the LBMA, that they're down to this much and they're going to hold deliveries off by 6 weeks because they can't meet the demand in that amount of time. So it's a very dynamic market. It does ebb and flow, but the dynamics, the trends are all in favor of silver investment.
Silver is up approximately 133% year over year as of mid-April. Recent recovery has been fueled by a softening US dollar and ongoing Middle East tensions. Looking ahead, if current supply constraints continue while demand accelerates, silver could experience a significant breakout. Any further stress in physical inventories or delivery delays may act as a catalyst for sharp upward price movements, potentially pushing silver well beyond current projections. If physical demand continues to tighten supply while inventories shrink, could silver be approaching a tipping point where price discovery shifts from paper markets to real-world scarcity? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.